In this podcast, I'm going to discuss current market events. The major market driver, at least of the economy, is the consumer, and what consumers do determines whether or not their profits, and that determines whether or not stock market prices are going to go up or down. And the impact of consumer demand shows up in borrowing, and that drives interest rates. At least it's a factor that affects us. And then it's finally is a decision about how do you actually divide your money? What's the asset allocation that actually works in the market? So my name's Don Creech, and we are going to get started. I'm also going to clear my camera just so those of you who are watching have the maximum amount of screen space to work with. So dealing with the recent data that has been present in the marketplace, I want to talk about economic data that focused on jobs. Job growth was relatively moderated, and prior to the prior month's numbers were revised lower. So the non-farm payrolls did increase 139,000 in May after a combined 95,000 in downward revisions for the two previous months. Unemployment's pretty flat at 4.2%. Wage growth did accelerate, and employers are still cautious, waiting for clarity on tariff impact, which is unfolding as I speak. Now, one of the major changes or important data points is the participation rate fell to a 3-month low of just over 62%. The rate for those between the ages of 25 and 54, which is the prime age workers, also declined. That's not good news. That puts pressure on businesses to do something to compensate, and they do that by incorporating automation or adding robotics. You want to look for the positive side in the employment data was that the federal government shed 22,000 jobs in May, and that's the most since 2020. Government doesn't create anything outside of regulations. It's a drag on the economy in the long run. So a reduction in jobs is positive. Now, what we need are consumers in the economy, because consumers generate somewhere around 70% of the total economic equation, if you will. And the government, and particularly the Fed, pays attention to what is called earnings growth in the personal consumption expenditures index. Now, consumers cannot consume without producing something first. So production in the economy comes first to generate the income needed for consumption. And we see that in this cycle of events. Individuals must produce, and out of that you get a paycheck, and you can consume. Consumption provides revenue. Revenue takes care of expenses, generates profits. That allows a company to hire more employees, expand the business. You get a change in demand and economic growth. We have more people working, we get more production. And it's just a continuous beneficial cycle. The annual percentage change in forward earnings tracks the yearly percentage change in the price consumer expenditure index fairly closely. That's why it's an important data point for economists and for the Fed. Today, more than ever, corporate executives have a large percentage of their compensation tied to company stock performance. So when they miss Wall Street expectations, it can lead to a significant penalty in the company's stock price. It's not surprising then that 93% of respondents to a business survey pointed to influence on stock price and outside pressure as a reason for manipulating figures through accounting gimmicks and buybacks. For fundamental investors, typically they are found in the American Association of Independent Investors, who, like Warren Buffett, spend a lot of times looking at financial statements, earnings reports, reading the footnotes of the annual reports to figure out where the gimmicks are and find out what's real and what is not. For fundamental investors, this manipulation of earnings skews valuation analysis to almost make it irrelevant, but certainly very difficult to get a true picture. What we do watch for is buyback activity, because buyback activity reduces the number of shares of stocks outstanding. So if you have 1,000 shares of stock outstanding and the company earns $10,000 and they buy back 10% of their stock, they still have earnings of $10,000, but it divided among fewer shares. So the data in the financial statement and the stock price valuation rises, even though they didn't sell more stuff or make more money. They didn't improve their margin. It is an accounting process of just simply, let's reduce the number of shares outstanding and my bonus won't get hit. But also the stock price is higher. So investors in the company, while they may not like the compensation paid, they're not complaining about a higher stock price as long as they're getting a piece of the action. The U.S. finances those stock buybacks by lending money to the corporations. We go back to the COVID era when interest rates were 2 to 3%. Some of the major corporations were borrowing tons of money at 2.25, 2.5 for 50 years. And I believe we actually had one company that made a 100-year loan. They borrowed the money for 100 years. At that time, the interest rate looked pretty decent to them. I'm saying to myself, you guys should be, stock prices are cheap. You should be buying back your stock price now. They weren't doing that. They were borrowing money. They actually turned out to have better vision than I did. They borrowed a ton of money, and now they can buy back stock prices without actually having to use up any of their margin. And they have a very, very cheap cost of money to get the buybacks done. In the process here, the U.S. has the world's deepest and largest bond market. It's roughly $29 trillion of outstanding treasuries, which are IOUs to be paid by the government to its creditors, some of which may be you, many of which are overseas investors. A lot of those are either foreign governments or pension plans who need long-term stable interest income. Now, the fact that it may be low because they did a lot of buying during the low interest rate period of COVID is not their problem, because what they have is stability of cash flow, assuming we can continue to pay our bills. Now, there's a great deal of heightened focus over the large U.S. deficit and the borrowing that will continue funding it. And recently, J.P. Morgan Chase CEO Jamie Dimon warned that the bond market will crack at some uncertain point down the road. There's a lot of argument that the U.S. will collapse, the dollar will be worthless, and we will be a bankrupt company like emerging markets. And when that happens, if that happens, that will create panic. There's no doubt about that. So-called bond vigilantes are back. Dimon just simply wasn't sure how long it will take before the crisis emerges. And our doubts about how this is going to pan out come from the fact that it doesn't matter which party is in power in Congress and writing the bills. Both of them want to spend money because that's how they get reelected. Cutting the budget is not popular with the people who vote, who have been receiving the money. So do not look for major cuts anytime soon, despite the promises of even the current administration. When we take a look at treasury yields, the bond vigilantes that I just referred to are ones who are in doubt that the government's going to figure out how to responsibly pay for its budget. Now, there's two ways to do that, one of which is spend less money, take it away from people who are getting the free handouts and not doing anything for it. Another way is, while that system is painful for the recipients, the other way is to create an environment where working is rewarded and the economy grows faster than the debt does. That has happened in the past. It's not frequent, but it has happened in the past. And all we need to do is actually raise the growth rate to about 3%, and we will outpace the cost of debt. We can eventually get it paid down and paid off. So there is hope there. It's just it's a long slug long slog to get that done. What we see here is that as investors worry, there is a divergence in where yields are. We have rising long-term yields and falling short-term yields. It's also generated a bunch of volatility in the market, and while which is the tracking mechanism is called the VIX, VIX, and it has come down. I mean, my goodness, it just accelerated during COVID. It calmed back down for years, and then the introduction of new tariffs by President Trump accelerated it again to basically to actual COVID levels. It was a state of panic, and it scared even the majority of professional money managers. It created uncertainty, of which there's still some hanging around. And when uncertainty abounds, strange things happen in the market that can be warning signs for the future. One of the brightest right now is the relationship between the dollar and long-term treasury yields. The relationship has broken. That's a spoiler alert. You've got to pay attention to what happens here. Traditionally, over the long term, treasury yields and the dollar tend to be positively correlated. They have a high tracking factor. When the return on dollar denominated assets, like the stock market, goes up and or the yield moves higher, it becomes attractive in the eyes of investors. They generally need dollars in order to buy those higher returning assets. However, as this chart shows, that correlation is broken down and treasury yields are rising while the dollar is falling. That may be associated with one, the doubt about what Congress is actually going to do with the debt, the fact that interest rates have not come down, a Fed decision, and third, the tariffs has disrupted confidence in the U.S. around the world, and we have a de-dollarization event going on globally. That presents some significant problems in terms of positioning accounts going forward. One of the ways we position accounts is rather than worry about the macro picture, which is where you find hedge funds, and that's the reason that hedge funds actually are underinvested in the U.S. stock market right now. It's because they reacted to the macro assumptions about the fear that would be and the negative benefits of tariffs being imposed around the world by President Trump. Turns out that they're wrong, which means that they don't own very much in the U.S. stock. But how do you forecast that? And we don't forecast stuff. We simply do not know how to tell the future. Nobody has a crystal ball, and it doesn't matter how many analysts come on Fox Business or CNBC and tell you what's going to happen. The fact is nobody knows. So how do you make decisions? In our process, we just simply look at what's going on. What is working in the market this month? And the chart that I have, we have a chart of basically all of Schwab's exchange traded funds, which are the cheapest in the country. So we rank these by returns over the most recent 21 trading days. That's a month. It discounts the weekends, takes them out of the calculation. And we post them based on what we call traffic lights. Are they green or red? And just like driving a car, if you have green traffic lights, it's full steam ahead. If it's red traffic light, you better put the brakes on and figure out what's wrong. And the typical investor doesn't do that. They simply buy a whole bunch of stuff because they've been told diversification is the answer. But Warren Buffett says diversification is for people who don't know what they're doing. So what we look at is where is recent performance. And as long as we own things that are at the top of the list in recent performance, we want to keep on holding them. When they fall at some point in time far enough down the list to be unattractive because other things are doing significantly better, it's time to rotate. We're not married to anything. When we take a look at the current list, I've pulled off here the top 10, and what we find is we have U.S. large cap growth, broad market, the Schwab 1000 index, which is mostly large cap stock. Then there's some small cap. There's large cap focus. There's international small cap. There's fundamental international small cap, and we've got some fundamental small companies in there. So one of the things this tells us that international stocks are important to be holding right now. And as a matter of fact, international stocks have been outperforming the U.S. since the beginning of the year. It didn't even have anything to do with tariffs yet, but internationally, countries have been lowering interest rates as their inflation rates have come down, and the U.S. has not done that. We've had falling inflation, and yet the Fed has said we're not going to cut rates. Basically, they quit doing data dependency to forecasting dependency, making assumptions about what tariffs should do in their academic world. When we look at the bottom of the list, what we find is bonds. We have short-term, ultra-short income bonds. We have 1 to 5 corporates. We have short-term treasuries. We have core bonds, aggregate bonds, muni bonds, inflation bonds, and several different treasury funds. And all of these are losing money. This happens to be an extension of 4 years of losing money in the bond market. In fact, foreign investor managers are making a tough decision that it's time to abandon the traditional 60-40 stock bond split of modern portfolio theory, because the core foundation of bonds as a safety factor against stock volatility has fallen completely apart over the last 4 years since COVID. Now, we have had better news in inflation, except every now and then you get a little bit of a tick upwards. So the recent data from Trueflation on aggregate inflation index is about 2.08%, but the news that came out today was even lower than that. So with a month over month of 0.1, I mean, that's a 1.2 on an annualized rate. That's really good news. And yet inflation, interest rates at the Fed remain around 4.5%. Well, that's substantially higher, and that's a drag on the economy. It prevents business from expanding when they have a real inflation rate that's virtually 3 percentage points higher than the cost of inflation. Now, we do show that inflation on a cumulative basis since 2020 is up 28%. That's why bonds are sucking wind, so to speak. They're not simply not winning, but around the world, when we take a look at what other central banks are doing, they're basically cutting rates. They already are dealing with lower inflation. They have plans for more and more rate cuts. There are a few that are raising rates. We've got some exceptions like Brazil, where they have political crisis, where President Lula, who just suffered brain surgery but is doing quite well, he's also signed 30 agreements with President Xi. The population doesn't like what he's doing, and it's very likely that he's not going to survive the next election. He will, because he'll be voted out, not because somebody's going to kill him. I don't know anything about assassinations in Brazil. So Brazil is probably going to hike at the current rate. Russia's hiking, Turkey's hiking. I mean, you take a look at the kind of politics and the economies they have, and there's no real surprise. One of the real surprises is Norway, who has an interest rate at 2, and they're thinking it should be higher. They're, with an inflation rate of 1.7, they want to, excuse me, their inflation rate's 2.5. They want to slow the economy down, I guess. When we turn around and take a look at asset allocation and how these interest rates impact us, what we find is that many companies are just simply hitting a pause button because they don't know what the rules for business are going to be in a week, a month, or even a year from now. Hopefully, over the next several weeks to a month, we're going to see more tariff agreements signed, and certainty will come back into the market, and business will be a lot more confident. Even if some tariffs are ultimately lowered or rescinded, the waiting period has an impact on business. Whether that pushes us to a recession or not remains an open question. There's no hard data yet. Some say it raises the risk significantly. But as I look at the market, I do not see professionals selling short. If they were taking short stock positions, betting on lower prices, then I would say, yeah, they think the recession is coming. They don't see that. Your professionals, your dark pools, basically the money managers of mutual funds and very large pension companies. They can call up General Motors CEO and say, hey, next week I'm going to be in town. I want to come by and talk to you. And I want a view of the factory and I want to talk to some of the management team. And guess what? Their call gets picked up and they put on the calendar. They get to go in and see this. So they have a very good idea already what's going to be reported in next month's earnings reports. And they're confident. Professional managers are confident about the earnings that are coming downstream basically for the rest of the year. That's positive. Even though the market seems jittery and you may be uncomfortable, the issue is, how do you make your decisions? Do you have a policy set of rules? That's what we do, is we have rules to follow based on actual performance of stock positions, exchange traded fund performance, what's going on in the market right now. Last month, we always share in our webinars how we were allocated in our three major portfolios. And we changed that over the course of time because the markets are dynamic. They do change. And your portfolio should adapt to reality. When you're driving a car down the street, you adapt to reality. The street winds and bends. You have traffic lights. You have a car pulling out of a driveway or across street unexpectedly. You adapt. Your portfolio should adapt the same way to the changes that are going on in the market. And that's what we do. What we do understand is we're not in the prediction business. We're in the interpretation business. We prepare for webinars every month and we do these podcasts several times a week. Markets are dynamic, just like you driving your car. They're constantly changing. And if you're going to preserve your account and achieve long-term growth, somebody needs to pay attention to it. Investing is not a job for slackers. Warren Buffett wasn't a slacker. He spent tons of hours doing research and reading through reports and visiting companies. Now, you and I can't go visit a company. We can't pick up the phone and call Wells Fargo and say, hey, we want to come over and talk to the CEO and take a look at your books. That's not going to work. But we can pay attention to whether or not a stock price is moving, whether or not a sector price is moving up or down or sideways, and figure out then how to structure our portfolio to deal with the current market. If you're not doing that, you're worrying. Somebody needs to worry. You should be worrying if you have no process. And most financial advisors in the business today, their process is hand-holding and telling you what they've been told to tell you about what's going on and why you own a particular fund or a particular stock. That's not research. That's simply client management. Very few financial advisors today are actually actively involved in managing your portfolio. If you want some actual help and have some discussion about how that works, give us a call and subscribe to our podcast. Thanks for your time today.